Good afternoon, everyone. This is Ed Talisse for Chelsea Global Advisors and the CQF Institute. It is March 27, 2015. This week, we're going to talk about three topics that all relate to quarterly earnings that the season is upcoming here in the U.S. Firstly, as the end of March concludes, it's interesting to look back and to screen for what worked for the first part of the year versus what didn't work for the first part of the year. So I'd say the biggest surprise that we've seen is probably the strength of the U.S. dollar that really accelerated from late last year into the first part of 2015. And on a selection basis or an asset allocation basis, what's really worked so far in 2015 is number one is being long Japanese equities, which have worked extremely well, and the headline indices are up about 11% so far this year. Also, European equities, particularly European equity index funds that have been hedged out of the euro and back into the U.S. dollar, have traded extremely well. Here in the U.S., the headline indices are basically flat for the year. Both the S&P and the Dow Jones Industrial Average are flat on the year after a couple of tough weeks that we've seen. Lastly, looking back, interest rate sectors, particularly long-dated government bonds in Europe, in U.S. to a lesser extent in Japan, have traded well, and some sectors that are interest rate sensitive, such as preferred stocks and select REITs, have also traded very well. So that brings us up into the earnings season that is about to commence. And we've talked about this before, and the pattern has been much that the market sort of gets very worried about earnings season, trades very poorly into earnings season, which has certainly been going on for the last couple of weeks. But as U.S. companies report earnings that are basically in line with lower expectations, the equity markets seem to recover and move on, at least for the next quarter. So we'll see how that turns out. Interestingly, there are 3 or 4 issues that people are absolutely focused on as the earnings season gets underway. Firstly, it's what is the effect of the U.S. weather situation on earnings. I myself live on the East Coast here in the U.S., and I can attest that the weather has been absolutely horrible. We've had more rain and more snow than is usual for this time of the year. However, on the west coast of the U.S., it's actually less rain and less snow, and temperatures are more warm. So there's a mixed picture there on how the weather plays out. Secondly, we've heard a lot about the dollar. Clearly hurts U.S. companies that need to move back foreign currency earned abroad back into the U.S. And that has really stumped some of these companies that have big foreign presences. And then thirdly, we've also had to deal with increased market volatility as the market really hasn't come to grips with what eventual Fed policy is going to be here in the U.S. As you know, last week, the Federal Reserve removed patience from their guidance, but it's still unclear if they're going to move later this year in 2015 or wait to 2016. On the more positive side, I think the surprises in Europe, where things certainly seem to be stabilizing despite the Portuguese events this week, but the European Central Bank delivering much needed liquidity with their quantitative easing program. So looking back on the first quarter, Japanese and European equities have traded well, to a lesser extent U.S. equities. Earnings season coming up, keep your eye on weather, the effect of the dollar, and the uncertainty still surrounding with the liquidity situation, particularly here in the U.S. Final thing I wanted to talk about this week is U.S. financials, and to a lesser extent financials in Europe as well. This sector has traded very poorly so far in 2015, despite the fact that most banks, including some large European banks that operate here in the U.S., passing the Fed's stress test, which basically opened the door for capital returns and increased dividends or share buybacks. However, the financial sector, as we've talked about here, is really waiting for higher interest rates, which really has not been delivered. They're waiting for a recovery in the U.S. consumer, where the dividend that has come from lower oil prices has not really panned out in higher spending from the U.S. consumer. So basically, U.S. financials are pretty much stuck in this rut where any sort of growth in earnings is dependent upon delivering on cost cuts and reductions in staff. So it's an important sector to keep our focus on, because I firmly believe that the financial sector at least has to be stable for the overall markets to see appreciation for this year. So that's it for this week. Thank you very much. Please check out the websites at the CQF Institute and my own website at www.chelseaglobaladvisors.com.